Hello everyone, how we doing? This is Miguel Rodriguez from Guerra Wealth Advisors. We're going to be talking today about the markets 2025, our August monthly market updates, what is happening out there, and what is it that we're seeing out there. And I'm very excited to talk to you guys and show you some very good key points on what's happening to the economy. So today we're going to be together for around 30 to 45 minutes, just mainly talking about the stock markets and what is happening out there. What are we seeing that could happen and how to prepare yourself for the next half of the year. Now, so to talk a little bit about myself, I'm a senior wealth advisor here in Guerra. I have a master's in finance. I have my retirement income certified professional designation, and I'm just blessed to be here today, guys, just to talk to you about the stock market. But enough about myself. Let's talk about Guerra Wealth Advisors. So in Guerra, we manage roughly around $800 million. We hold our clients' money in Fidelity investments where we help them make better decisions with their money. Now, when for our clients, they might know this already and they went through this process, but we might have some people in here in the live that they might not be our clients. So just to tell you a little bit more about ourselves, our clients go through the five main areas of financial planning. Number one being retirement income planning, getting to that point of retirement that you have enough money to sustain yourself through retirement. You have enough cash flow to maintain that lifestyle that you might have. Setting up that withdrawal strategy, not only to put you through retirement to minimize taxes and risk as well, because there's different ways how you could set that up. Now, investment management, how can you optimize the growth of your money? How much reward can you get by the amount of risk that you're taking? Tax planning is a process that we go through with our clients that could help you save thousands of dollars in taxes. That's a big deal. That's actually one of my favorite areas that we put our clients through. Number four and number five, it's asset protection, estate planning. You want to have everything in place in order, God forbid, something happens catastrophically in your life and you're no longer here with us as well, and you have to avoid the court of probates. You want to have your wills, your power of attorneys, your trust in place to avoid all of this. Now, so for the new families, they go through this entire financial planning process. So if you're not one of our clients and our clients went through this just in a different way, we go through this report card. Now, we'll analyze your current situation, we'll grade you on how you're doing things right now, your current structure, we'll define how you have everything structured right now. We're going to look at things that you're not doing, and we're going to see how we could help you improve those areas that you might not be optimizing in that sense. Now, don't be upset about the grades. The idea is to show you what are the areas of opportunities that we could help you with. Now, if at that point we could become your financial advisors, absolutely. Might be the financial planning firm that could help you put yourself through retirements and be there for your family. Now, let's talk about the webinar. So today, what we're going to cover is markets. We're going to look at what is happening with the markets, what's driving the markets, and what are the main trends that we need to be looking out for. There's a lot of things that are happening right now in the stock market that could impact the next 6 months in the economy. So we have to be on the lookout for that. And we'll discuss that as well. Now, we're going to talk about inflation. We'll look at interest rates and what are the other things that are happening as well. Also, we're going to look at opportunities and possible risks that your portfolio or your financial plan might be facing over the next 6 months. Now, it's going to be a fun webinar. We're going to talk about lots of data points and how these things could affect yourself and how can you prepare yourself to navigate this potential volatility that's coming our way. Throughout the webinar as well, I'll be answering a couple questions to see what will be general questions. I can't answer specifics to yourself because I might not know your full financial picture. But the idea is to interact a little bit back and forth to see how we could help everyone. Now, last month, we actually, Mauro, who's an advisor here in Guerra, the founder of Guerra Wealth Advisor, and Miguel Castañeda, the other Miguel, I'm junior in that sense, we went to the New York Stock Exchange. We got to talk to many other financial planning firms to see what are we doing with the current status of the stock market, what is happening out there. We have some of the major institutions present to us as well, giving us insights on what is the perspective with the economy and how they're preparing themselves for the next 6 months to a year. Because there's many things that are going to be changing over the next 6 months to a year. So we have to make sure that our clients' financial pictures, they are covered with all these new things. It was a very unique experience. Very, very unique experience. And I'm very happy that I got to experience that with the founder of Guerra Wealth and Miguel, an advisor here in Guerra that's been for over 13 years. It's insane. He's been here for over 13 years, and I'm proud to say that I have a very good relationship with him. But enough about ourselves. Let's talk about the market. Now, let's start from the beginning. How has the S&P 500, the economy, done since January 1st of 2025? The S&P 500 has performed at 9.59%. Can you believe that? Back in April, the market was down. People were freaking out. Some people made bad decisions and got out of the market in April. And the market is back now at all-time highs, 9.59%. It's amazing how the market bounced back. It's one of the most unique times in history how the market did this rally over the last 3 months. Now, the Nasdaq 100, which is the 100 biggest companies in the tech sector, has done 13.4% for the year. Very good performance. But now you have to understand, if all of your money were in the Nasdaq, you're only investing into one single sector. Because you might see this, Miguel, wow, I really like that sector. Let's put all the money there. That's not really a financial plan. You're just putting all the money into one single ETF or one single sector. And if what happens in 2022 were to come around again, where the market went down and that sector got absolutely affected by it, it went down over 20%. You want to be diversified and you want to have a structure to your money. Look at the Dow Jones for the year. It's up right now 4.5%. So as you guys could see here in the volatility, since the market started this year, it's been very high. It's important to understand how is your portfolio structure right now and what type of risk you're taking with your current portfolio. Now let's zoom out a little bit. Let's look at the last year. How has the market performed over the last year? The S&P 500 over the last year is up 18.61%. You want to make sure that your money is structured in a way that you're getting the most reward by the amount of risk that you're taking. Huge in that sense. Right now, for example, if someone's in their 60s and myself cannot be taking the same amount of risk, I might look old, but I'm not that old. You have to make sure by the right risk tolerance that you have right now, you're getting the right amount of reward, the most amount of reward in that sense, but not taking the most risk in that sense. Now, the Nasdaq over the last year is up 25% and the Dow Jones is up 11%. And look at the volatility that we saw this year with the tariffs. Market went down and then it bounced back. We had a very nice rally over the last couple months. But right now we're getting closer to September and October. August right now is almost done, but historically in September, the market lags a little bit. We tend to see a lot of volatility. We'll talk about that now in a second because there's certain things that are happening in the economy that we're facing a very unique time. Now, let's zoom out even further. Let's look at the last 5 years, how the S&P 500, the Nasdaq, and the Dow Jones have performed. Look at this. Over the last 5 years, the S&P 500 has done 91%. You want to make sure that if you have a financial advisor already managing your money, they getting the right amount of reward by the right amount of risk that you're taking. If you're someone that has over 30 years into retirement, you might want to look into this. You might be paying fees and overpaying in fees and not getting the amount of reward that you might be expecting. Look at the Nasdaq over the last 5 years, up 113%, and the Dow Jones is lagging a little bit behind at 59%. So this is something that when people only look at what's happening today and they forget to zoom out, they forget that we've been here before. The market works in cycles. And historically, the economy, we're big believers in the economy, the market will go up over time, but you have to be ready and your portfolio needs to be structured in a way that you're ready for these things right here, the volatility that you're going to experience. Look at 2022. Back in 2022, you might have forgotten already, inflation got as high as 9% and the market went down. Interest rates were going up. So it was kind of like the opposite that we're seeing right now, where interest rates right now they're predicted to go down and inflation has been going down. Now, let's talk about a couple things. So if you have any questions, please drop them down in the chat below so we could go ahead and address them. But now, going into sector performance, we have seen for the year, here are all the different sectors that are inside the S&P 500. Remember, the S&P 500 is the biggest indicator of the economy of the United States. Here are the largest sectors. So information technology has done for the year 15%. It's been the best performing sector for the entire year. But look at over the last 3 months, that sector went up 25%. It had an amazing rally right after tariffs. So, but during tariffs, that sector was not performing very good because they depending a lot of the money and a lot of their goods that get imported from the outside. So that sector went down. So you have to be strategic how you position your money and how is your money diversified across the different sectors. Look at this defensive sector, utilities. For the year, utilities has done 13.1%. Amazing. A sector that people tend to forget about. It's done very good for the year. Because right now, when you look at the stock market, a lot of the money is concentrated in the big names. And where if those big names are not reporting good earnings, that might affect the stock market as well. So we're talking about Nvidia and all these different companies. You need to be diversified. Your money needs to be across different things. You cannot have all your money in one single sector. Historically, you might be leaving money on the table, or you might miss out in the opportunity cost by the market performing better. Now, when you look at the market right now over the last couple of months, what has been the main factor of this rally? Tariffs. Tariffs right now being delayed, the conversations with China has impacted the market in a good way. So the economy hasn't been growing as much. We had GDP that came out. It was a good sign. It was 3%. But right now, the big fear is our price is going to increase with the tariffs. So the market right now is a little bit on the unknown in that sense. Even though the market is pricing in interest rates to go down now in September, the market really likes that. That's why you're seeing this rally happen over the last couple of weeks. Now, inflation, let's talk about that. Inflation right now, the estimate was about 2.8% and it came out 2.7. So inflation was cool in that sense. It was not the inflation report did not come out as hot. So right now, that changed the overall perspective with the Federal Reserve and interest rates. Inflation is going down. So their fear was, okay, so if we lower interest rates too fast, that might cause inflation to go back up. And with all of this unknown with tariffs, we might have to raise interest rates again to pause inflation from going up. So right now, with inflation actually going down, that's a good sign for the Fed that they could lower interest rates. Look at this right here. Inflation going back to 2022, as I was mentioning earlier, that peaked over 9%, has gone down tremendously. But here's something funny that I had a conversation with my father about a couple months ago. Miguel, you're saying that inflation is going down, but when I go to the store, the prices of things keep going up. Well, that's not what inflation means. It doesn't mean that the price of goods is going to go down. It means that moving forward, the price of goods is not going to go up as fast in that sense. Historically, we know that the price of goods is going to go up. So that's why your portfolio with the right amount of risk needs to be ready to outperform how fast is that inflation going up by. So if inflation is going up year over year over 2.7%, and your money is not growing at 2.7%, you're losing buying power. So you have to be aware of that as well. Now, going back to this, when we are making decisions here in Guerra Wealth with our clients' portfolio, we do something that's called sector rotating. We are making decisions historically. How is everything that's happening right now to the economy? How will that affect every single sector in the markets? The market works in cycles. The market likes certain things and does not like certain things. There's sectors as well that like certain environments in the economy and does not like certain environment in the economy. So for example, historically, there's a certain sector when rates go down, that sector tends to go up. Those companies that are invested into that sector leverage and borrow a lot of their money to finance their daily operations. So if rates are going to go down, that means that those type of companies could access more capital at a cheaper rates and reinvest it back into the business, meaning that could cause more expansion in the economy. Those business owners could hire more employees. Those employees will get jobs, and those employees could go to someone else and spend money in their business. The money would flow in that sense. Now, let's talk about interest rates. So there's a tool that we use. It's called the CME Fed Watch tool. This tool looks at ahead in time to see what is the market pricing in to happen with interest rates. The market right now is pricing in a 94% chance. This is very high with the information that's out there in the markets for rates to go down. So some people ask me, Miguel, if rates do go down, can I refinance my 7.5% mortgage down to a 3? I would love to say yes, but most likely it's not going to happen that way. They're going to lower rates little by little. Right now, the expectation is that rates will go down 0.25%, and they'll be around this area right here, 4 to 4.25. Now, when rates go down, historically equities tend to go up, but right now we're heading into a very unique time. So rates going down, there's going to be cheaper loans, mortgages, the housing market, we'll talk about that as well. That's been hurting with rates being so high. There's a lot of people that want to buy a house, but they cannot afford these high mortgages. So I'll give you an example. A $600,000 mortgage right now is going to be over $5,000 a month. You need to have a high income to be able to afford that comfortably. So the housing market right now, we're seeing a very delay in that sense in terms of performance. It has gone up, but not as high as we've seen over the last 5 years. Now, if they cut interest rates way too fast, that could cause inflation to go back up, and that could affect the stock markets. Raising rates again, that's going to scare the market away, and then the stocks might pull back. Historically, it has happened before. So when Jerome Powell is making these type of decisions, he has to be careful how fast he's going to lower interest rates. And there's a lot of reports and news out there that there's a lot of conflicts when you look at things with Jerome Powell and Trump, how they're looking at things. Trump, he wants the rates to go down. He wants the economy to go up. So Powell does not want to lower rates too fast because that might cause inflation to go up and it might cause a little bit of tension. So you see in the news right now, there's a lot of name calling, there's a lot of things going on. And in that sense, that's why your portfolio needs to be diversified. It's very volatile out there. So the volatility is only going to increase in that sense. And we'll go over that now in a second. So what could happen over the next 90 days that could affect your portfolio and your retirement plan? There's a lot of things out there that could happen. Now, number one, tariffs and interest rates, they're one of the biggest decision makers of what could happen over the next 90 days. If tariffs for XYZ reason go way back up and the negotiations don't happen according to the plan, that could affect the markets. A lot of the companies import their goods, and that could fear and that could affect the logistics behind these companies and the profits, and that might trickle down to the consumer. So there's a lot of fear with that. Now, interest rates staying high for longer, that could affect the market as well. So if rates do not go down, even though we have a high probability that rates go down now in September, that could cause the market to pull back. Now, hopefully I'm wrong. Hopefully it does not happen. We don't see that happening according here to the probabilities, but it could happen. News could hit the market right now, and that could scare the market away. Now, historically, as I was mentioning earlier, there's different sectors in the stock market that when rates go down, they tend to rally. So if you want to talk about these different things, do you even have these sectors in your portfolio and you want to be diversified and taking advantage if that opportunity does come around, we could set up a meeting and talk about those things because it's not all about putting the money into that one specific sector, betting on that. That's not really a plan. That's not what we do here. We're not here to tell you, hey, put your money into this one specific investment. That's not really a financial plan. We're here to give you a structure to your money to put you through retirement and give you the option that working for you, you don't have to do it. If you decide to do it, you could do it because you want to, not because you have to at that point. Now, as I was mentioning earlier, there's a lot of unknowns in the world. If another war breaks out, that could affect the stock market as well. Hopefully not. We keep talking about those things, but hopefully none of those tensions take place and affects the stock markets. Now, right now, the market is at all-time highs. You want to make sure that you're taking the right amount of risk according to your risk tolerance. It's so simple. You sell high, you buy low. You buy low, you sell high. Right now, we're at the high. If your portfolio is overweighted in the terms of you have too much money at risk, it might be a good time, according to your goals and your financial picture, to lock in gains and put into something that's more, let's call it conservative, but it still is a high producing instrument, a financial instrument, to give you more growth as well. Now, I have met with different families that, Miguel, yes, the market keeps going up. Well, the market's going to pull back at some point. Do you feel comfortable with the amount of money you have exposed to this type of risk? No, I don't. Well, you want to sell high and lock in the gains and distribute those gains into different vehicles. It's the time to do it right now. You don't want to do it later on when the market pulls back, right? Because you're losing opportunity costs. You're getting less money, right? So right now is a good time to sit down with your financial advisor and your planners to see what is the amount of risk that you're taking right now, or do you even feel taking that amount of risk and risking that amount of money that you might have in equities in the stock market right now. So it's a very good time to do that. Just take the exam. It's literally an exam that we do for our clients to see how's their risk tolerance. It's a conversation. Hey, how much money do I have exposed to this stock market right now? And do I feel comfortable that if the market pulls back 20%, it might comfortable seeing that pullback in my portfolio? I'll give you an example. You might have, for example, $500,000 in the stock markets at risk, at high risk, let's call it positions and equities. And then you might have, I don't know, $500,000 in lower risk positions. If the market pulls back 20%, you're going to see your portfolio pulling down $100,000. How would that make you feel? Are you going to be able to go through that? Because the market takes time to recover as well. Would that prevent you from retiring? Would that affect your lifestyle in any type of way? You have to sit down and analyze that with your financial advisors. We're not only here to help you grow and protect your money, we're here to help you make those decisions. How's your risk tolerance? That could change in a matter of a couple months because some things could happen in your life. Now, let's talk about the housing markets. The housing markets has seen some volatility, tons of volatility over the last year, at least here in Miami. So we did a study that we went back to every single June, going back all the way to 2013, if I am not mistaken. And we looked at how many sellers were in the market at that point compared to how many buyers were out there in the market looking to buy a house. Right? Makes sense? So right now, we had 1.9 million sellers in the I'm sorry, in the housing markets. And there was 1.4 million buyers in these stock markets. That's very high. There was a difference of 36%. Sellers outnumbering the buyers. That's not good. Last year, there was a 7% gap. That gap just got wider in that sense by almost 29%. That's very high right now. So why is that happening? Interest rates being so high, as I was mentioning earlier, that's keeping a lot of buyers in the sidelines. A lot of buyers are waiting for interest rates to go down to go into the markets and seeking properties in a way that their monthly is not so high. Well, what does that mean right now for the buyers? If you're able to buy a property, that could give you some room to negotiate these properties. And sellers are cutting the prices of the houses at a faster rate right now. So affordability right now in the market is not very high. That's why another reason that rates need to go down. So there could be more buyers out there. So this cooling market right now could also slow down constructions. If you guys look in the up in Florida, there's a lot of houses in, for example, Lehigh Acres, Cape Coral, Sarasota, that they're sitting in the market for over 60 days and they're slicing their prices very fast. So it's not really a a market for sellers to be stubborn in that sense. It's a market. If you're trying to sell your property, you might have to be willing to drop down the price. And then if you're a buyer, that might give you some wiggle room to negotiate some good deals out there, if it makes sense. Because here's what happens, right? I had a conversation with a different family about a week and a half ago. They were trying to buy a property, an investment property. Fantastic. Let's sit down. We'll help you through that. We have the right team here in the office that could help you buy this property. But let's sit down and run the numbers. What is the goal behind this property? Is it for cash flow? Is it for appreciation? Is it for both? So we sat down, we ran the numbers. This family, if they bought this property, it seemed like a good deal, but when we sat down, we factor in taxes, insurance, and the mortgage, and the rent that they were expecting to get from this property, they were going to be on the water around $500 to $800 on a monthly basis. So they will be losing money. So when we sat down, we saw the numbers, we came up with a plan. Hey, if your goal is still to buy a property, you need to do a couple of things. You need to drop down the price, negotiate the price down so it gets to the point that you're making, at least you're breaking even on a monthly basis. So we had to sit down and come up with a plan. It's not just going out there, I'm just going to buy a property because I know I'm going to make money monthly. That doesn't really work all the time. Right now, it's a tough market for investment properties with rates being so high and the mortgages with these rates being so high. You might not be cash flowing at all or making a little bit. And are you willing to be making 2 to 3% of your money on a property with the hassle behind it when right now there's money markets and CDs making 4 to 5%, right? So you need to sit down and analyze that as well. Now, let's talk a little bit about what are we expecting for next year. So historically, next year, there's something coming up in the stock markets. We have midterm elections. Historically, the markets in midterm elections doesn't do so good, regardless of politics, Republicans, Democrats, because right now it's very divided. Depending what channel you watch, you either might love or hate what you're hearing. So you have to put that aside and see how the market performs during these times. So as you see in this visual, which I shared last time, is a very good visual. Volatility next year is going to spike up in the months of August, September, and October. Historically, the market pulls down at those times. As you can see here, the market doesn't do so good in those times. But after that, the market tends to rally. And as I was mentioning earlier, we're at all-time highs. If we know that the market historically pulls back in midterm elections, are you ready for that? Is your portfolio structured in a way to minimize the downside and when the market bounces back to maximize the upside to take advantage of the different opportunities? Are you ready to take advantage of the tax planning opportunities that could take place in a downturn market? Because people think when the market goes down, there's no tax planning opportunities. Yes, there is. There's different things you could do. And there are massive things that you could do to save tons of money in taxes throughout your life when the market is down. So when the market is down, I'm talking to my clients constantly to take advantage of different opportunities. When it comes down to taxes, not only for market performance, by you doing this, you can make thousands of dollars over time by taking advantage of these opportunities. So yes, portfolio needs to be structured correctly. to get ready for next year if the market does pull back, and also to take advantage of different opportunities in terms of taxes. Right now, with the Big Beautiful Bill, there's many different things that you could use into your financial plan. That's another webinar that we'll do just specifically about the Big Beautiful Bill. Now, let's go back to this in a second. As I was mentioning, interest rates are expected to go down. Actually, it's right here. If interest rates go down, as I was mentioning earlier, historically the market tends to go up. But we're in a very unique time. Interest rates possibly going down and midterm elections going on next year. The market has had a couple years that has been killing it. 2023 market rallied. 2024 market rallied as well. It had an amazing year. 2025 market keeps rallying. 3 years in a row that the market is doing good. Historically, in midterm elections, market pulls back. The market does not only go up. You have to be ready for the volatility. Hopefully, there's not volatility next year. Absolutely. I'm investing myself in the market as well. I will love for the market to only go up, but that's not the case. People tend to forget about that. So you have to put the greed aside and have your portfolio and your financial plan ready for this volatility that might be coming this way. Not only the portfolio, having the right tax plan, having something mapped out. Hey, if that does happen, what can we do in terms of taxes to maximize this downturn? So when the market does recover, us making more money. Now, going back to this, you need to know what percentage of your money is actually exposed to the downturns of the markets. That's an analysis that we do for our clients as we meet with them. And that's an analysis that the new families could sit down with us and see, hey, Miguel, how much money do I have actually exposed if the market goes down? How much can my money go down if another 2008 were to happen? And how much of my money do I have in safe vehicles, in low volatility vehicles, right? You need to have the right structure with your financial plan. As you're getting older, by the rule of law, you should not have all your money in the risky buckets because you're getting older. Your risk tolerance and the need behind this money is going to be there. If the market pulls back, you have less time for it to recover. So you have to be ready for those things. Now, this is the overall picture of a financial plan, all the different buckets where you could allocate your money. You need to know how much money you have in each bucket and what does that mean for your financial plan. What is the withdrawal strategy that your financial plan has? If the market goes down, what's going to be the new withdrawal strategy out of your portfolio? Because if most of your money is here and the market went down and you're withdrawing from here, you're selling at a loss. Opportunity cost, risk of sequence of returns. You're selling at a downturn of the markets. You're selling equities when the market is down. That's not good. That's why you need to have a withdrawal strategy. Very simple. Market goes down, you don't touch these buckets, you eat from these buckets. Market is up, you might lock in the gains from these buckets, feed this bucket, or use these gains that you had here to use for income, for your lifestyle. It's simple than what it sounds, but you need to have a plan in place. You cannot put this aside and think about, hey, I will do it in 6 months. What if in 6 months the market pulls back and all the possible gains you had in the table were taken away? You have to value how good the market has done over these last 3 years. It's done very good, but the market does not only go up. We have to be ready for the volatility. Now, we go with our clients through an entire financial planning process. So if you're a new family and you would like to meet with us, here's something that we could do. Number one, we have what is called a discovery meeting. We get to know you, understand your goals, what challenges you might be facing. And then we have a freedom plan. This freedom plan is when we analyze everything that's going on in your financial picture and how can we help you identify the areas and the challenges that you're facing and possible solutions. Ideally, by that point, many families are ready to move forward, having a financial planning like ours, where we look at everything. Then we'll have different sessions where we will talk about the investment strategy, the different buckets, how can we create the withdrawal strategy out of those different buckets. Then we'll have a tax planning meeting strictly about taxes. How can we help you save money in taxes? How much money can you help yourself save in taxes? And what does that look like? Then we'll have an asset protection meeting. God forbid you have a lawsuit, medical expenses. Do you have the right legal structure in your companies? What does that mean in terms of liability? We'll have that conversation. And lastly, we have the estate planning meeting. This is a very important meeting. Having the right legal structure, your power of attorneys, your healthcare directive, your pour over wills, your testaments and wills, deeding the properties into a trust. All of those things need to be in place when you're creating a trust, creating the right restrictions to your money when you're no longer here, so the right people in your family get this money in a manner that you want them to get it. So this meeting right here is huge because you need to control your money. You don't want the courts to decide on your money. You might not want your money to go through probates. It's expensive, it takes time, and they decide who gets this money. After we go through this unique financial planning process, we have what is called financial reviews with our clients, where we meet at least twice a year, but ideally is quarterly. We want to sit down, talk about your life, how is your financial planning going so far, any adjustments that need to be made, or have your goals changed. Also, we will talk about what things have happened with fiscal policy with the governments in terms of taxes that we could help you implement in your financial plan, or as well with the stock markets, any changes that we need to do. And as well, we need to be ready as you're getting older, having everything in place to transition these assets to your family. So at some point with many of my clients and our clients, we sit down with their kids, the next generation, and we start teaching them, hey, when mom and dad are no longer here, here's how everything looks like. Here's what we need to do in that sense. Because you want to make sure that your kids or your family make good decisions with your money, right? So, by the way, if you work with a firm like Guerra, you're not only hiring a financial advisor, we have a whole team here in the office. We have over 60 employees that help you and put you through retirement and help you make those decisions. Here's just a leadership team that you see everyone here in the office. I'm just blessed to be the one talking today. Now, actually, I'm not in that picture. Where am I? Oh, there I am. I saw myself. I have my face in the middle. Now, if you would like to have a financial meeting with us to review everything that you have going on, and if you're one of our clients as well and you haven't had a financial review over the last couple of months, you could scan this QR code, we could book a session with us, and then we could see how we could help you make better decisions and how we could help you update your financial plan if you're one of our clients and something has changed. And now I'll answer a couple questions here about the webinar and the content that we had. Let me take a couple seconds to put the questions up. Ba, ba, ba. What do we think about artificial intelligence? Well, artificial intelligence, that's a sector that's been doing very, very good in the stock market. As I was mentioning earlier, that's been one of the main drivers in the stock markets. That sector, many of our clients, is part of their portfolio. We don't have all their money there, absolutely not. We have to diversify the money, but it's a sector that has been performing very good. It has been killing it over the last couple of years. But it's a sector that could keep going up. A lot of companies are implementing all this new artificial intelligence into their business model to make more efficient decisions and have a more efficient model and run operations more smooth and cut costs as well. So yes, it's a very good sector. Maybe one sec. Here's another question. Oh, I see that you can scan due to the picture. Oh, don't worry, we'll send now the link here in the chat so you could book the meeting. So click the link now that we'll send on the chat so you could book a meeting. Now, something that I want you guys to think about. If the market goes down tomorrow, call it 10 to 15%, are you ready for that drawdown in the markets? Is your portfolio ready enough to sustain that drawdown in the stock markets? You need to understand how much money you have at risk. It's not only about going up, as I mentioned earlier. Another question here. Ba, ba, ba. How can you maximize diversification? Well, maximizing diversification, look at the different buckets. There's many different things that go within each buckets. Our clients, as we're making decisions with the investment strategy, we'll talk about all the different structures and all the different investment vehicles that are inside of each bucket according to their needs. We'll talk about ETFs, stocks, mutual funds, bonds, structured notes, REITs, all of these different things. And what does that mean to your financial life? And how can we implement it in a way that we're getting the most reward by the amount of risk that we're taking? Now, taxes. I want to end this on taxes I want you guys to sit down tonight and think about, hey, how much money am I going to pay in taxes through my entire retirement? It's a big deal. Those are projections that we do for our clients. And how can I help myself minimize that amount of money that I'm sending to the IRS in terms of taxes? There's many different things that you could implement to minimize the amount of money that you pay in taxes. If you're one of our clients and you want to sit down and revisit that conversation, absolutely. Click the link below. We could revisit that conversation. You might even have that plan in place already, but you might not remember. But if you're not one of our clients and you have never or want to revisit that conversation, you just click the link below. It's a big deal. It's not only how much your money you're making, it's how much money you keep. And we're here not only to help you grow your money, to protect it as well. Market risk and IRS. We wanna also minimize this as well. Now, I want to take the time just to be grateful for you guys to log in tonight. And oh, I see one last question here. What are some defensive sectors that you might want to recommend? I can really recommend you some defensive sectors. Well, I'll just name a couple of them. Utilities is a very known defensive sectors, and healthcare as well. Healthcare as well. This year is not doing so good. It's down, but utilities, as I mentioned earlier, is a very known defensive sector and has done very good this year. So those are a couple of sectors that you could look into defensive. Now, with that said, guys, thank you so much for tuning in tonight. I'm blessed to be here. And now I'll see you. Actually, I won't see you next month. I'm getting married next month. I'll be my honeymoon next month. Most likely, I'll see you in October to update you guys about the stock market and what's happening with the economy. And if you're one of our clients, I most likely see you around the office. And I hope everyone does good and